Capitalwealthcounsel is an authorized financial service provider. For all your financial needs, please contact us at www.capitalwealthcounsel.co.za.
Good morning, my people. Welcome back to Capital Wealth Counsel. Welcome back. Today, we thought it's high time we drop another video or share some info tips, information that you probably would appreciate, especially if you're looking to build wealth over time, and you can only do that by investing and putting some of your profits aside where you can actually get better returns. And there's so many ways to invest these days. The markets are really wide, and today I thought we need to discuss the psychology of investing as a topic. I think it's become one of the most pillars to success or even failure, depending on how you react when your investments are doing well or when they're not doing well. So psychology of investing is the info tip for the day. I just want to remind all the viewers that the topics of discussion today or whatever we share does not constitute a financial advice. This is just info tips, just shared in general. And if you do need specialist advice specific to your circumstances, I think I advise you contact a professional or even book a consultation with one of our advisors at Capitalwealthcounsel.co.za. By way of introduction, my name is Edward Banda. I'm a certified financial planner, also an advisor at Capital Wealth Counsel and a member of the Financial Planning Institute with over 18 years experience in financial planning, asset management, investment advisory, tax planning, insurance in general, wills and trusts, just so to mention a few. And that's purely for those that are new to the channel. Welcome. Please remember to follow, like, and subscribe, or even leave comments down below for any topics that could be of interest to you, so we'll be able to share the relevant info tips. Like I said, the only reason that triggered this conversation is, I just thought, when it comes to investing, the most important, from what I've seen in my experience, is, if I was to ask a question, how do we keep calm amid financial market turbulence? When markets are down, are you also down with them emotionally? Or when markets are up, are you overexcited and you tend to overinvest? And just to scratch the surface, one of the important aspects in investment, or how you'd measure whether your investment will be successful or a failure, is predominantly your asset allocation. Basically, where you investing your money. Is all your money sitting in shares or equity? Or are you investing in bonds? Are you investing in cash? Are you investing in property? These days there's even investments in cryptocurrency and things of that sort. Those are referred to as assets. So how you allocate your assets could become one of the key elements. Also, I think you also need to take into account, depending on the size of your investment, taxes also become an area of concern, where you say, okay, if I make a beautiful return, how much taxes am I due to pay to the Revenue Authority? As well as estate planning. Yes, you do need to plan for your estate in case you pass on. Is your investment going to transfer successfully with minimal taxes, or will your loved ones suffer significant expenses in inheriting that estate? I did load a video around trust and estate planning. You can just search our channel and go and have a look. Very important information shared in detail around that aspect, which also applies to when you are investing. And then obviously your investor behavior, which is topic for the day. How do you behave in good or bad times? I'm just going to scratch the surface though, just to give you guys info tips on things that you should be looking out for. But again, it's not full-on advice. You definitely need to consult with a professional in order for you to be able to understand your psychological behavior, and this can be done through risk profiling before you actually get started. I mean, if we were to ask the question, I mean, what is investor psychology, or in other words, psychology of investing? I mean, some definitions, you can look it up online on the internet these days. I mean, it's basically just a study of emotional and cognitive factors that influence the decision-making process of an investor, right? Basically, this study refers to mental and emotional factors that influence an investor's decision-making process when it comes to either buying or holding or selling your investment. So when you buy, what is your mental state? And when you're losing, are you going to keep on holding to your investment, or do you quickly switch and change, which is predominantly selling of your investment holdings? And I always say, to my clients, most of the time, the ones that are looking for higher returns, I mean, we all want higher returns. We always want the best outcomes. But the point to note is that investing is not a betting shop, guys. I mean, it's not a lottery. And that's why majority of us we always need to sit down with a qualified professional to guide us and set realistic goals, and manage those goals and objectives that you put in place. I mean, if you play the lottery, it's win or lose, and half of the time, I think the ratio of winning or losing the lottery are very, very slim. Hardly do we see people win, but once in a while, people do win. With investments, with careful planning and strategy, you could always come up with the best outcome. But again, you have to manage all these different points, which predominantly includes your behavior. And also, you gotta know, I mean, there are no magic bullets when it comes to investing. And every investment has its own risks, and some of the few strategies that can help you manage your behavior. I mean, I attended a conference where behavior psychology was really dissected into detail. And one of the most important things that we got to take into account as human beings, we are emotional human beings, is to acknowledge envy, that we are envious human beings. And you always envy investment portfolios that would have done well. I mean, even when Bitcoin first hit the market, there are other people that would have missed those opportunities to invest in cryptocurrency, and who probably would have been envious on our colleagues that would have made a lot of money. And maybe if you invested at the wrong time, you could have lost your capital within that short space of time. So envy is realistic. One of the examples they actually use in behavior psychology with regards to envy, there have been many studies conducted about Olympic athletes or Olympics, basically. And one intriguing factor is around, the bronze and silver medalists. From behavior psychology, it turns out to be that the person that achieves a bronze medalist from these studies are likely to be more happier than the silver medalist. Basically, if you think about it, the guy who takes bronze would have made it to the podium, and if you look back, those few split seconds is basically the difference between podium or no podium, win or lose. So if you achieve bronze, I think it makes sense to hear that these guys are obviously more happier than the guy that achieves silver, because the silver guy is looking to get to gold, and the failure of achieving gold would actually depress the silver medalist. And from what I get from this analogy is basically we got to celebrate the small wins, and that applies with investments. I mean, we've seen markets collapse where people have lost substantial amount of money because the economy is not doing great, and therefore when we compare how other portfolios would have performed compared to your portfolio, if you lost 5% of your investment capital and there are other clients that would have lost a minus 20%, you probably should be happier with your loss, because had you been in a different position, it means your losses would have been higher. So it's those little moments and psychology of our behavior that could help us either succeed or fail. So envy, one important thing, and effectively to that, you also gotta recognize your losses, because investments in nature are risk. There's no guarantees. So sometimes your portfolio could experience some losses, and sometimes would experience higher returns. And if you're able to recognize that tendency that volatility is a reality, and depending on how long you want to stay invested, it could either help you to stay the course and stick to your investment strategy and objective, which over time will then give you the outcome that you need. But again, all this speaks to for how long you want to invest and when do you need to access those funds and so forth. But recognizing loss is one of the most important strategies when it comes to managing your behavior as an investor, as well as timing the market. Timing the market essentially means how long are you going to stay invested. If you're in a losing position, are you going to keep that position and wait for the investment to recover? And there's always an analogy between which we call timing the market versus timing the market. It's very difficult to time the market. So there isn't really the best date or time to start investing, because if you're able to time the market, that would have been the greatest gift, right? But reality is none of us can do that, because unless you're a fortune teller, then maybe you could be the best investment advisor for yourself. But essentially, what this speaks to is that do not fear loss in your investment portfolio drive your decision, because then you might not be able to get started, and you'll be the one person that would prefer to keep money under the mattress as opposed to actually exposing it to markets where you can actually improve your investment returns. And obviously, you gotta build discipline. Now, discipline is very, very important in so as to stay the course, stick to your objectives, and things of that sort. When it comes to loss aversion, and historically, just to, bring as an example what could have happened in the investment pace over the past decades. You probably we've all have heard of the Great Depression of 1929. I think that was the biggest period where we saw significant losses. The Wall Street or New York Stock Exchange lost equity value, lost around 89%, if I'm correct. Yeah, in 1929, when there was a Great Depression or the stock market crashed, the New York Stock Exchange lost 89% of its value. You can imagine if you had 100,000, it means 89,000 rand of your money gone off the surface, and your balance in your investment account would be sitting at about what, 11,000. Yeah, that's significant losses, and it's this type of events that will tell you how how you'd react. Had we been around during that period of time, the Great Depression, I think by far the highest losses experienced in the market. Another recent event, we all know about the 2008 financial crisis. Some would call it the Great Recession, but that lasted, I think, for about a year or so. Notably, the S&P 500, it's an index in the United States that tracks the top 500 stocks or largest companies listed on the New York Stock Exchange. That lost just over 20%. So investments do lose value. But again, when these markets are crashing, it opens up opportunities for new investors to actually buy into the markets when the prices are low. And obviously, if you've been invested for a very long time, that becomes a litmus test basically on how you'd behave and react to that. Hence, investor psychology becomes one of the most important areas where, as financial advisors and financial planners, we need to educate our clients and maybe provide this information to you because these events do occur. And if we were to schedule a meeting with you to say we need to review your portfolio and your investment is not performing, it does not mean you've made the wrong decision. Maybe it's just the time, and maybe what you then need to do is to measure your losses compared to other losses, and therefore you'd find that diversifying your portfolio becomes very important, and the use of qualified advisors and discretionary fund managers could then help you to manage such risks. You may have heard of words like the ostrich effect in investment jargon, if you read a lot about investments. This is just basically a terminology that describes cognitive behaviors that how people often avoid negative information. You know, how we all don't want to hear the bad word, including feedback that could help you monitor your goals and progress within your investment portfolio. And half of the time, people don't want to hear the negative. And instead of dealing with the situation, we either bury our heads in the sand like an ostrich would do. And these conversations, yes, tough as they may be, and optimistic as you may be to have started putting money aside and hoping for the best, there will come times when your investment is not performing and we just gotta deal with the situation. Sometimes we will stay within the portfolio that's losing value and we'll continue investing. But again, like I say, investment is not a betting game or a gamble. But you, in a way, depending on how you react to gains or losses, you either will stay the course and continue betting on a losing team, which could eventually maybe increase the odds of you making a higher return should that team actually start performing. So again, those strategies are very, very important. I mean, this is just to scratch the surface and not to bore you with too much jargon or complicated situations. But again, if you've already started investing, you probably will experience a lot of emotions, high and low. And I think for me, the key learning factors around this conversation is just to remember that when you're investing, you literally not joining a betting game or a gamble. It's not a lottery. And secondly, you just gotta focus on your objectives or maybe stay the course. I mean, if you're investing for your child's education, for your retirement, if you're investing for a short-term goal, an emergency, all these objectives will then govern how you select your portfolio. Therefore, portfolio diversification becomes important. And not all of us are experts. That's why we source the services of experts who then manage your investments or your funds. And they know where to diversify the portfolio. I mean, recently, if you look at statistics, I just recently learned that AI artificial intelligence is becoming one of the widely used tools in healthcare. In 2003, yes, 2003. So last year, the United States healthcare industry, apparently just around 30% of surgical procedures in the US were done using robotics, and so basically an operation can be done using a computer technology together with human intervention. So, I mean, there are so many investment opportunities. Who would have known that, AI could be one of the biggest investment opportunities or industry in this world. And therefore, if you do not have that information at your disposal, all is good to then leave investing to the professionals. You provide the capital and they manage that capital for you in a professional manner with the relevant data available to the professional to help you grow your money and similarly also help you learn on how you can manage your behavior to make sure that everyone succeeds, you know. So basically, all I'm trying to say is, you know, don't be afraid to invest. I mean, the regulatory landscape, especially if you're investing with regulated entities, the landscape is there to protect the client, and the client is the center of everything. There's transparency in terms of the agreements you would sign with the asset manager, financial advisors, with regards to the fees they charge, historical performance and future performance, and the customer is always protected. And I think the sooner you start, the more you learn, and the better your wealth creation journey becomes. I think let me leave it here. And thank you so much for watching the channel, the show, and we appreciate your support at capitalwealthcounsel.co.za. If you need to consult, speak to one of our certified financial planners, and just to understand how we can help you grow, protect, or even manage your existing investment accounts. You just visit our website, www.capitalwealthcounsel.co.za, or leave a comment down below. Like and subscribe to the video so you'll be the first to be notified whenever we upload new info tips. Like I said in the beginning, this does not constitute financial advice, just to give you guys info tips on how you can manage, you know, your monies, and let's all grow together. Thank you for watching once again. I'll see you in the next video.